Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, January 13th at about 8:30 Mountain Time. Quick housekeeping note, we've received some mixed reviews on the quality of our audio on these weekly uh, audio video summaries. And so we're recording today directly into the Substack app. So by all means, please let us know if the quality is any better. The note this week was titled Choose Your Battles. It was a reference to Fed staff and a number of the participants seemingly picking a bit of a political economic fight with the incoming Trump administration. We saw in the minutes cuts to the growth outlook and increases to the inflation forecast, a clear sign that they thought Trump policies were much more negative for the broad economic outlook than Biden policies. That strikes us as extremely curious and likely politically biased. We cited a Wall Street Journal op-ed from last year that noted at the Fed board down in DC, the ratio of Democrats to Republicans of the staff economists was 48.5 to 1. So the market doesn't really agree with them in the sense, or at least in terms of business confidence and what people expect. But we are having a broad risk off environment in treasuries. We've been warning the biggest risk to the markets was bear steepening driven by real rates, not by the inflation outlook. And that spreading to the entirety of the equity market. We often get asked, why has the equity market been shrugging off higher rates? And our typical response in our TV appearances, in our writings is it hasn't. It's been an increasingly narrow rally. That was true over the last couple of years broadly. And that's because while rate policy was tight, which was putting pressure on small banks, small businesses, small caps, stock prices, that is, the Fed's balance sheet was incredibly accommodative for fixed rate, longer term borrowers, and fiscal policy was incredibly accommodative. Well, those two things are changing now. And so we're getting closer to the point where we have a broad risk off, sell everything kind of correction. That's what Friday looked like. And we're getting a little bit of a taste of that on Monday morning as I'm recording right now. So one of the other notes around the Fed is Vice Chair for Supervision Barr resigned his position as head of the bank supervisory role. He should have resigned from the entire board. He wasn't good at all at his previous job. He completely misdiagnosed the origin and causes of the regional bank crisis, and his solution of just raising capital was completely wrong. And we don't know what he would bring to the table in terms of monetary policy either. He should move on and go back to a law practice or something else and leave that spot open for the Trump administration to replace him. He's not done that, obviously. And so how that regulatory team gets revised is gets set up as an open question. We're not particularly worried about inflation. Any month's prints could be negative, but more broadly, measures like market-based core, which Governor Waller spoke about last week, or the multivariate core, which is the baby of the New York Fed, are moving down. Housing-related inflation is going to put pressure on the core in the first half of the year. We've been getting a little bit of a dissipation of core goods prices as of late, but we don't think that's going to last. The dollar's had a big move. That'll put downward pressure on import prices. And the deflationary impulse out of China persists. Even last night in their trade data, ordinary imports are still falling. China is putting a deflationary impulse out to the rest of the world. As far as last week's employment data goes, the bottom line is it does tie the Fed's hands likely through the March meeting. Now, we don't think demand for labor has picked up. We saw lots of funky stuff. That's the technical term in the data. There's been a big surge in jobs in the 16 to 24 age cohort. We think that that's likely a function of seasonal adjustment factors having been corrupted by the pandemic when students didn't go back to school and didn't take temporary jobs over the holidays. Retail jobs picked up. There's lots of problems with the data. But from the Fed's perspective, because January reports have been very strong in the last 2 years, if we get that again this year, there's almost no way the Fed will be in a position to cut the policy rate in March as a consequence of their employment part of their mandate, even though we think demand for labor is weak, as evidenced by softer wage data as well. We're going to get the Atlanta Fed numbers this week, which should further confirm that. So on balance, the markets are boxed in. We don't think we're quite at a buying opportunity yet. And we would hold some powder in reserve for either bonds or stocks at this point. This is Barry Knapp from Ironsides. Please consider becoming a full subscriber. Make that your New Year's resolution. Have a good week, everyone. Thank you.